Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer 2 more Ask James questions of the day. We have this question from Lance. Lance says, I heard that risk is relative to the time frame. So if I have a longer time frame, can I take more risks? And I know that I have to plan for at least 30 plus years for retirement. Absolutely, Lance. Your question raises some, critical points about risk, time frame, and retirement planning. Let's dive deeper into why simply extending your time frame doesn't necessarily mean you should take on more risk, especially when focusing on retirement income with reduced risk and volatility. First, it's crucial to consider the emotional aspect of risk tolerance as you approach retirement. While it's true that having that longer kind of investment horizon can potentially recover from market downturns, the psychology or the psychological impact of volatility tends to increase as you rely more on your investments for income. During your accumulation years, fluctuations in your portfolio may not affect your daily life significantly because you're not actively withdrawing from it. However, as you transition into retirement and start relying on your investments to fund your lifestyle, even temporary drops in portfolio value can have a more pronounced emotional impact. This emotional aspect, often referred to as, EQ, right? Emotional quotient, can influence how you experience and manage financial decisions in retirement. Second, let's address the misconception about time frame in retirement planning. While you may have 30 years or longer horizon from the age of retirement, to life expectancy, the nature of retirement income planning shifts the focus from accumulation to distribution. Unlike during your accumulation phase where growth and long-term returns are prioritized, in retirement, the primary goal shifts to generating income while preserving capital. For instance, if you retire at 65 and anticipating needing income for the next 30 years, you're not looking at a 30-year retirement horizon in the traditional sense. Instead, you're concerned with funding your retirement lifestyle through withdrawals from your portfolio. This means the effective investment horizon in terms of income generation is considerably shorter than the full span of your retirement years. This shift from accumulating wealth to distributing it means you need to consider the average weighted maturity or duration of your investments, especially in bonds and other income-producing assets. Therefore, the approach to managing investments in retirement involves balancing risk and return to ensure you have a steady and sustainable income stream pulling in, right? This often means focusing on investments that provide reliable income through interest and dividends and other sources, while also protecting your capital from market volatility. Strategies may include diversifying across asset classes, focusing on dividend-paying stocks, bonds with varying maturities, and possibly incorporating annuities or other guaranteed income products to ensure a stable cash flow. So in conclusion, Lance, right, while longevity does extend your financial horizon, the shift from accumulation to distribution in retirement necessitates a different approach to risk management. It's essential to consider both the emotional and the financial aspects of risk tolerance and to structure your investments to meet your income needs while safeguarding your financial security throughout retirement. By doing so, you can better align your investment strategy with your retirement goals and enjoy a more financially secure and emotionally stable retirement. Hey, great question. And I hope this provides some clarity on, navigating risk in retirement planning. So, hey, thank you for the question again. And if you would like to send in your question, you can do so by emailing it to poollocke@poollocke.com. Our second question is from Cynthia. And she's wondering, do I need 30 bonds or so to be diversified in the bond market, just like I would need in the stock market? So are they similar? Cynthia, that's actually a great question. and it dives into an important aspect of bond investing and diversification. Let's break it down further in the context of retirement income focused on reduced risk and volatility. So do you need 30 bonds to be diversified in the bond market, similar to stocks? Well, yes and no. Diversification is key in any investment strategy to spread risk, but with bonds, the dynamics are a bit different. Here's why. Bonds, especially investment-grade bonds, are generally considered more secure than stocks because they represent loans to governments or companies backed by a promise to repay with interest. So for this reason, you can achieve diversification with a slightly smaller number of bond holdings compared to stock holdings. Typically, having around 20 different bonds can provide sufficient diversification, especially if they are spread across various sectors and issuers. This allows you to manage risk by not having all of your investments tied to one sector or entity. However, there's a practical consideration here. Unlike stocks that trade frequently and in smaller increments, bonds are negotiated transactions. When you buy or sell a bond, the pricing and liquidity can vary, especially for smaller blocks of bonds. For instance, if you have less than $5,000 per bond, it can become challenging to sell them quickly if needed. Therefore, to effectively diversify in the bond market, you ideally want larger denominations like $10,000 per bond or more, which requires a more substantial investment amount. Right? For example, if you aim for 20 bonds averaging $10,000 each, you would need at least $200,000 to build a diversified bond portfolio effectively. Now, this is where bond funds come into play. Bond funds pool together investments from multiple investors to buy diversified portfolio bonds managed by professionals. This allows you to access a bond spectrum, kind of a bigger spectrum of bonds, even with smaller amounts of investments. Now, bond funds offer liquidity and the ability to easily adjust your investment without kind of facing the complexities of individual bond transactions. However, it's crucial to note that investing in bond funds comes with its own set of considerations and risks compared to holding individual bonds. Bond funds do not mature like individual bonds, and their value can fluctuate based on interest rates, changes in market conditions, things like that. This is, this difference between holding an individual bond versus bond fund is significant and should be carefully considered based on your financial goals and risk tolerance. Kind of wrapping it up, Cynthia, while you can achieve diversification in the bond market with fewer holdings compared to stocks, the amount of money needed to effectively diversify can be higher due to the nature of bond transactions. Now, bond funds provide an alternative for investors, looking to diversify with smaller amounts of capital, offering liquidity and professional management. Ultimately, your decision should align with your retirement income needs, risk tolerance, overall financial strategy. So, it's a good question, and we often dive deeper into the nuances of bond funds often during these Ask James questions. So, great questions today, and if you would like to send in your question, you can do so. You can email them to poollocke@poollocke.com. If you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. See you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.